Hey, party people. Ben from Pivot Wealth here. And today I'm talking about the investment and property market update for the end of June, the end of the financial year for 2022. I'm going to run through some of the key market data and what you should be thinking about to make smart decisions around your investments based on what's going on in the world today. So, guys, look, just before I jump into the content, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly suggest you seek out personalized advice before jumping in. You should be thinking about doing that anyway. And guys, just as we're going through the content today, if you've got any questions about any of the stuff that we are covering, please feel free to pop that into the chat or the Q&A as well. So, look, in terms of what's happened in markets, some of the in the news stuff that we've seen a huge meltdown in the cryptocurrency markets. Bitcoin and the crypto mega cap index is currently down like 65% since the highs of last year. We saw also since the last update, a huge meltdown with crypto staking and Terra Luna fiasco, most notably of that. A lot of ruptures going through cryptocurrency markets. A lot of investors caught holding bag. And some real issues there. It seems that where the market in particular is subject to these sorts of ups and downs, and I think that this is obviously a big down. My take is that things will recover, but it is a matter of time, and we're potentially in for a little bit more pain before we get there. And I think a lot of people that were all in on crypto as the foundation of their investment strategy have probably got caught short, and a good reminder that having a good foundation of probably less interesting, maybe a little bit more boring investments is probably something pretty sensible as well. We're seeing obviously, and this is everywhere, you would have missed this one unless you were hiding under a rock, that inflation is way up. The inflation data in Australia, record highs. And as a result, interest rates are on the rise, with the RBA really wanting to crack down on inflation and get that under control. Bit of pain ahead for mortgage holders. We've already seen that, some pretty big jumps in the fixed interest rate market. Just over the weekend, I think CBA came out with a 1.4% increase on its fixed rates. NAB followed suit, 1.1% increase. There's still some competitive deals out there, but interest rates are definitely on the way up. And something that's really important, I think, for anyone working on contracts where you've got income that's tied to an end date, that you want to be really careful with how you're running your risk management around property. What that's led to is some declines across the property market broadly. Now, a really interesting one, there's a ton of headlines out there which it grabs the attention around property, that the RBA has forecast a 15% decline in the property market by the end of 2023. Essentially, that they've actually just increased that prediction to say that they're now forecasting potentially a 20% decline. And it's got a lot of people, obviously a bit nervous. Now, my take on that is that we are seeing that different pockets are impacted differently. So areas where there's a lot of supply and less demand have been impacted more. Areas, the good quality blue chip areas where there's very limited supply and very strong demand, have still held up particularly well. You think anywhere close to Sydney, Melbourne, Brisbane CBDs in the more premium suburbs doing well, as well as different pockets throughout each of those bigger markets as well. So I think that there's a lot of negative talk out there, but there's also a lot of positives as well. And it's reminding me a little bit with some of the talk around the property market in particular, of the COVID talk that people were saying where, the property market's going to melt down. And then when JobKeeper finishes, that, everybody's going to lose all this money, and it didn't happen. And we do see softening in the property market from time to time, particularly following some of the rises like the ones that we saw through 2021, but they tend to recover reasonably quickly and reasonably strongly. So I don't think it's a huge area for concern. And I think for anyone, and I probably got this in another slide, but for anyone that has property on their roadmap, I don't see any issues with buying property in the short term. Take advantage of the opportunity while it's there. Get into the market. Yes, we might see a little bit more of a decline in the shorter term, but it's highly unlikely if you buy a good property in a good area that 5 years from now, 10 years from now, you're going to regret getting in now. But it is really important that you've got good quality risk management in place so that you're protected if things do keep deteriorating the way some people are talking about that happening. One of the other things that we're seeing or have seen in the news over the last little bit is that there's been a lot of measures around first home buyer support rolling out. Saw a big one in New South Wales with the transition or the option to not pay lump sum stamp duty, but instead pay a property tax. A lot of social debate about whether that is the right thing, because when paying an annual property tax, you will end up paying more over time. But the fact is that it's going to allow more first home buyers getting into the market. We've also seen a big expansion in the federal budget of the first home buyer, first loan guarantee scheme, and an expansion of the first home super saver scheme as well, which I think something, again, that's going to help a lot of first home buyers get into the market much faster, and all very positive things. Labor obviously have come into power. They're now coming out with October. There's going to be another federal budget, which they're going to make their own. Obviously, the last budget being released by the Liberal government, who are now out of power. And given how much they're talking up their focus on housing affordability and first home buyers, I think it's likely that we're going to see some more measures there, which hopefully help people and the market even further. And again, I think this is one of the factors that can have a positive impact on the property market over the next little while. In terms of the actual numbers, though, that we're seeing in property markets, so over the month of June, we saw the Sydney property market has declined by 1.5%. That's down from 0.9% in the previous month. And that actually marks the fifth straight month of losses for the Sydney property market, with it now being down, I think it's 3.9% from memory over the course of this year. Now, putting it in perspective, if you think of a $500,000 property, that's about $20,000, which $20,000 isn't nothing. But given that property increased by $100,000 over the course of 2021, it sort of puts things in a little bit of perspective. Obviously, again, there's a lot of negative talk out there in the news around the property market's declining. When you look at the actual dollars, the dollars say that it's not actually that much. So that's the Sydney market. Then Melbourne down by 1%, which is up from 0.6% the previous month. Brisbane, Adelaide, and Perth are actually still growing as a property market. So slight growth in Brisbane, 0.2%. That's down from 0.8% the previous month. Adelaide at 1.3% growth from 1.7% last month, and Perth at 0.3%. Now, all three of those markets are still growing, but the growth is slowing down. And across the five capital cities, we've seen 0.8% decline, which is more than increase from 0.3% in the previous month. In terms of the share markets, we saw in the Australian share market, so the ASX 200, that's the 200 largest companies in Australia. So the combined value of those companies was down 8.9% through June. It's now down 13.8% for the financial year to date. But when you compare that to the American markets, which is the S&P 500, that's the 500 largest companies in America, and the NASDAQ index, they're both down about 9%. And the NASDAQ in particular is down 29.7% for the year to date. S&P 500 down 20% for the year to date. Both of those are now in official bear market territory, which is bear market just means a declining market where the share market is down by 20% or more. So those markets have been impacted. When you look at the Australian market in context, it's gone down, but it's gone down significantly less. So it sort of talks to the strength of our economy. And it also, the companies that have performed well over the last little bit are mining and resource companies, which we have a few big ones. So that's helped support and I suppose slow the decline in the share market as well. The cryptocurrency index is down 42% last month. So that talks to the crypto market meltdown that I mentioned before, and is now down 63.3% 2% for the year to date. So huge numbers there. And yeah, as I said, a few people that have been caught well short there on the cryptocurrency front. Our investment story of the month, bit of an interesting one for Collins Foods, which is CKF on the ASX. They run KFC and fast food franchise chains, so think Taco Bell, etc. They've seen 46% profit growth in the current financial year, and the share price as a result is up 18% in just the last week alone. Clearly, as economies start opening up with the other side of COVID, that fair bit of growth in this space. So an interesting one to watch moving forward. In terms of things to look out for in the markets over the next little bit, or some of the things that we're looking at, we're seeing this uneven property slowdown. So I mentioned that we are seeing some big forecast decline, but my take is that it's not happening in all areas the same. Good quality suburbs are holding up really well. And I think that that's something that's likely to continue. But you think those more fringe suburbs where there's a ton of new developments coming online, that they're going to be impacted a lot more. We're seeing a lot of investors being really fearful at the moment and reading a lot into all of those headlines and the attention grabbing headlines that are out there, and really sitting on the fence. I think that's a real mistake in the current climate. I think risk management becomes really important when we're experiencing periods like we are, but doing nothing is, you are still making a choice. And often that means missing opportunities. So it's important that you've got a clear plan in place, educate yourself, have a clear plan, and know what you're doing so that you can make the right moves at the right time and actually come out of these periods of market disruption in a stronger position than what we went into it. Another thing to look out for is the inflation and wage data. I think those two elements, and I get that it's quite confusing, but they're really crucial over the next little while. If inflation keeps running away in the rate that it has, we're going to see interest rates ratchet up really significantly, and that's going to have a big slowdown effect on the economy. Whereas if that starts coming into balance more quickly, then we're going to see the interest rate impact is going to be less, and the economic impact is going to be less. And wage data, I think, is a big part of that as well. So how much wages are growing, that feeds into inflation data and household wealth numbers as well. And I think the crypto challenges are going to continue in the shorter term. I think if there's any really significant negative, like significant problems in that space in the short term, it could have a pretty drastic impact on what happens to those markets in the shorter term, because people are really on edge when it comes to crypto, seeing it off the back of the massive losses we've seen over the last little bit. Getting into the some of the economic data, in Australia, we've seen inflation is up 5.1%. That's up from 3.5% last month, which is way above the RBA's target band of 2 to 3%, and that's why they're so concerned. The current household savings rate is 11.4%, which is down from 13.6%. So people are winding back on their spending, which is not surprising given that inflation is running so high and wages aren't keeping up with inflation. So people's what they call real disposable incomes are actually declining. So it's not surprising that people are saving less. We are still seeing really strongish economic growth. That we've seen 3.3% annualized growth in Australia, down from the previous period, but that's still a pretty solid growth rate considering the conditions that we're seeing at the moment. And this is what I mean when I say that we've got a lot of the fundamentals in place that can drive the share market and the property market and investment markets more broadly over the next little while. Unemployment, I think, is probably the one stat that could potentially save us from a recession here, where the unemployment rate is at 3.9%. That's a 50-year low, where if people have still got jobs, then it does really reduce the impact of economic slowdown and interest rates and those sorts of things. Unemployment growth. So in addition to the fact that unemployment is low, the number of jobs and the number of people in the workforce is also still growing. So it's two positive things working together there. China growth is steady at 4.8%, which is good, because China's growth impacts our growth because they're a key buyer of our stuff, essentially. And the Australian dollar has strengthened a bit against the US dollar at 71 cents, and is actually forecast to go back to a more normalized level of about 76 cents over over the course of the rest of this year. Now, that's one of the reasons that that's important is because a lot of investors in Australia, in their super funds or in ETFs or managed funds or whatever, you're buying shares in US companies. So when the Australian dollar falls, the value of your US shares go up. And when the Australian dollar strengthens, the value goes down in relative terms. So something to keep in mind if you're looking at your investments and wondering how, when the markets are moving in a certain direction, your investments might be going in the other direction. It often comes down to the currency impact there. And the 69 cents has been historical low growth rates. As Australia starts to increase its interest rates, what happens is that foreign investors put more money into Australia to take advantage of our higher interest rates relatively, and then it strengthens the dollar from there. Some of the US economic data, and it's a bit of a bleaker picture over in the US at the moment, which is really important with the US being a key driver of international markets, is their inflation is at 6.3%. The GDP growth, so their economic growth over there is at 1.2%, so still positive, but really slow. Their unemployment rate steady at 3.6%, which is incredibly low. Their household savings rate, though, has massively declined, which it seems like something that probably doesn't matter that much. But when we're coming into periods where there's economic disruption and economic challenges, when the household savings rates are really low, it means that there's not a lot of protection in place for households. So when the economy starts to perform poorly, and you can see that the growth is quite slow in the US, it means that they're more, the impact of economic slowdown is more because households don't have war chests to fall back on. The last piece there is that house sales are down by 10% over the last little while. So we had seen really strong growth in the property market in America, but as these interest rate increases and inflation starts winding through, that we're seeing the property sales down 10%. We obviously saw that huge impact in the global financial crisis in the US and what that did to their economy and markets around the world. Thankfully, they've put a lot of protections in place to avoid that sort of situation happening in the future. But we want the US economy to be firing because we know it's better for global markets, investments, and our economy as well. In terms of some of the trends that we've been seeing over the last little bit, as I mentioned, crypto investors have really been punished for being all in on crypto. And look, I'm a fan of crypto. I've got some crypto myself. It's a small part of my portfolio. And I think where people go wrong when it comes to crypto is starting with crypto and having that as the foundation for their investments. If you had the bulk of your investments in crypto, with the market being down 65% since their highs, it's a pretty stressful ride. So yeah, I think a good reminder to make sure that you've got the right foundations in place for your investments so that you're not running such a super stressful strategy for your investments. Another trend that we're seeing is fear around the property market. And I mentioned that there's a ton of headlines out there on this at the moment that people are really fearful. People are also sitting on the fence thinking that the market's going to go down further. And we're seeing all these dip chasers that think that they might be able to pick the bottom of the dip and swoop in and pick up a bargain when it comes to property investments and right off into the sunset with their gains. Now, you might do that if you're incredibly lucky, but it is pretty hard to pick that dip. And in my view, most of the time what happens is that people don't realize that a dip is a dip until it's passed. So I mentioned at the start that if property is something that's on the roadmap for you, I wouldn't be afraid to pull the trigger at a time that makes sense, because while you might not pick the very bottom of the dip, it's unlikely that you're going to look back in 10 years and think that you've missed, that you picked the wrong time. So it is really important with these market conditions that you've got a clear plan and the right strategy in place. But once you do have that, then my view is that you shouldn't be afraid to pull the trigger, knowing that you're taking property as a long-term buy and you're taking a long-term view. Another trend that I'm seeing, and I think that the COVID crisis really wised up a lot of people to the fact that, markets do go up and markets do go down, that when markets are declining, that's the time that there's an opportunity to make a bunch of money. So we're seeing smart investors that have learned that lesson that are now getting, sort of like buy one, get one free on their share investments, taking advantage of the market conditions. Also, with a bit of softening in the property market, people are getting ready to execute and pull the trigger to make those investments happen and happen sooner. And in my take, that's a smart play, and means that you're not only you're not just sitting there stressing out while markets are declining, but instead you're taking advantage so that you come out of the other side of the period of disruption stronger, or in a stronger position than you went into it. Also seeing, a bunch of first home buyers taking full advantage of some of those new initiatives out there, particularly the super first home super saver scheme and the expansion of the first home loan guarantee scheme. Those schemes allow you to essentially buy a property with only a 5% deposit without paying lender's mortgage insurance, and to save the money pre-tax using your superannuation. Gets a little bit complicated, and there are a few risks in this strategy, but it means that you can essentially get a lot of your super saved with a lot of your property deposit saved through super with pre-tax dollars, and then get in without paying lender's mortgage insurance and get a solid property. So if you meet the criteria, it's something that you should be seriously looking at. If you think that you might, reach out to either us through the financial education program, or get a good mortgage broker and speak to a mortgage broker. Again, you can hit us up if you need a recommendation there, but they're the ones that can guide you through that process. Make sure that you confirm eligibility and get your ducks lined up so that you can take full advantage there. Wanted to chat about some hacks and mistakes, and starting with our client story of the month. This one was for an individual in their 30s, income at 350K, assets and investments of $550,000, saving around $10,000 per month. They came to us with no plan or strategy. He was overwhelmed with all of the options and had no tax planning around strategy, getting really frustrated with paying a lot of money in tax as well. What he wanted was a dream home, and having that financial security. And what we ended up doing through the planning process was pursuing an investment property purchase with a strategic tax plan and share investments on the side, as well as upgrading the principal place of residence and another investment property in the near future. What we also were able to deliver through that planning process was giving confidence in the trajectory that he was on, because this guy was in this pattern of he had a lot of good things going on, but he wasn't sure if what he was doing was enough to get to the goals that he had for himself. So he just going through the process and seeing how his situation would play out into the future gave him a lot of peace of mind that he was on a path where he was going to end up in a place that he was happy with, in a time frame that he was happy with. And look, the power of small changes can make a big difference. We measure the upside benefit as a result of implementing like the strategies that our clients have decided on. And for him, it was $53,000 in year one, and that was increasing to $800,000 by the end of year 20 from just making some small changes at the front end. So look, I share these stories because I know that people don't talk about the ins and outs of their money. So sometimes hearing what other people have done can give you some ideas as to what might make sense for you. Our client problem of the month was stress around fixed rates expiring. And I was actually just putting together some content on this, that found that 40% of mortgage holders in Australia have fixed rate mortgages, which are expiring over the next few years. All of those people are going to be coming into an environment where the interest rates are much higher than what they're currently paying. So that does cause a little bit of stress and anxiety. I think if that is something that you think is going to impact you, then you want to have a clear plan for what you're going to do. And the easiest time to make that plan is right now. If you wait a month, 6 months, or you wait until your fixed rates expire, you might find that the options that are available to you are going to be less. So knowing what you need to do and starting on that path now means that when it comes time to actually having to do the thing, that you're going to be ready. The mistake of the month, and we've seen this in a few different formats, but sitting on the fence while the market is moving. Again, just this paralysis around fear of markets and what's happening mean that people don't, it's natural that people don't want to, do something dumb and cost themselves a bunch of money, but they end up sitting on the fence. And before you know it, markets have recovered and you've missed the opportunity. Or even worse, you think that you can actually just pick the decline and that you're going to find the perfect time. But I can tell you from experience that almost always doesn't happen. So it is, again, risk management is important here, but knowing what you're doing and then actually doing it is going to be what actually drives results for you. The hack of the month is taking action when the opportunity exists. So whether it's starting a business, buying a property, starting your savings strategy, starting an investment plan, that when that opportunity is in front of you and everything makes sense, that you want to be taking advantage. And our client success story of the month, and this is a really big one, that index investing confidence is something that I think is really important. And what I mean by this is that with a lot of clients that we work with, when we help them with their investing, we tend to follow an index type fund approach where they're just investing into the share market overall and basically buying a little bit of every single company that makes up the share market. Now, what I found is that when COVID happened and the markets went down by 40%, the index funds went down by 40% along with it. But a lot of people educated themselves through that period and came to realize that their investments were down because the markets were down, and it wasn't really something that they needed to stress about. So now this time, when we're seeing this period of market disruption, we've noticed that a lot of people that have learned that lesson are saying to themselves, well, yes, this is what happens. This is what investing is about. And it means that they're less stressed and they've got more confidence in what they're doing. And a lot of them are asking, can we be investing more and can we be doing better? So I think that's a really good lesson to learn, and something that's going to generate a lot of wealth, I suppose, for people that are taking the right approach here. So guys, that's it for me for this month. I will catch you on the next one. Bye for now.